All right. I think it's good evening, right? Yes. I mean, good evening, everyone. Today I'm going to talk about like the sparse mean reversion portfolio selection. Um, yeah. So a little bit about me first. Okay. Let me move this away. All right. Okay, I'm currently a PhD candidate in health informatics at University of Minnesota. I joined Hudson and Thames as an apprentice in November, and right now I'm a researcher at Hudson and Thames. This talk is actually like a earnings report, like a quarterly report for me. During this time, basically, I worked on the co-integration module in ArbitrageLab, and basically I worked on the simulation, the minimum profit optimization strategy, and multivariate co-integration strategy. And in the recent month, most of my work has focused on the sparse mean reversion portfolio selection. If you have any questions or you want to connect with me, so here is my social media details. All right. Okay. Here is like the outline of today's presentation. So I will probably I will introduce first why do we need sparse mean reversion portfolio, like why sparse, and then I will go through the steps on how to actually select a mean reversion portfolio selection. This will be covering from like mean reversion strength metrics. This is like the thing we're going to optimize. And I'm going to talk about several methods on how to select the sparse mean reversion portfolio. Basically, there are like three ways. First, you can use like lasso to cluster the assets. So you can have like a smaller investing universe to select from. Or you can use the greedy algorithm to construct a sparse portfolio selection from scratch. Or we can use some other methods in convex optimization to derive a sparse mean reversion portfolio. And then I'll show you how you can use ArbitrageLab to help you calculate these portfolios. All right. Basically, all my work, like 80% or 90% of the work is based on this paper. So like during the last month, I've been like reading, basically I'm just like spending all my time with this paper. So it's kind of like a love-hate relationship. So now I'm kind of happy I have implemented like basically all the ideas in this paper, and actually like extended some of the ideas also with their future, following paper, and all of these papers are included in the reference part, and you can download them with ease. All right, so let's get started. So why do we need a sparse portfolio? Firstly, we want to trade mean reverting assets because the trading strategy are rather straightforward. No matter what kind of like trading strategy you're using, basically we're trying to like buy low and sell high. However, because price of single assets are usually non-stationary, so you will rarely spot a mean reversion in single assets. And also, even if you spot the mean reversion in single assets, they often suffers from like low volatility, or they're like illiquid, or the mean reversion happens at improper timescale. So it will like take months or years to revert to the mean. At that point, you probably just want to trade like momentum strategy, like to do trend following. And finally, to like mitigate with these drawbacks, usually people will trade more than one assets. They will either like creating a mean reverting pairs, or they're creating like a multi-asset baskets. So they're trading like more than three assets. So previously I talked about like co-integration. Co-integration works pretty well for pairs trading, but not for multi-asset baskets. So for one thing, co-integration tests cannot handle too many assets. I think in Ernie Chan's algorithmic trading, that book, he mentioned that the co-integration test implemented in MATLAB can only handle about like 12 assets at most. I'm not sure like if this limitation has been lifted in the Python implementation, but for sure that your test power will decrease as you are including too many assets for your co-integration tests. And co-integration test only focuses on stationarity. It doesn't really care about like the volatility of the co-integrated spreads or other issues. For example, you really cannot take into account the transaction costs or like the leverage you're using just by doing co-integration test. So here we need some other methods to control these issues. So the reason we need sparse portfolios is first, it is low in transaction costs because you're trading fewer instruments. Also, you can easily explain the P&L to your boss because you have fewer assets to trade. And also, furthermore, like you can use like fewer leverage just by trading fewer assets. So here I have like a toy example here. Actually, it's not a toy example, but here I used a investing universe consists of like 45 international equity ETFs, starting from 2016 January up to date. This is the data set we'll be using throughout this talk. So you can see these two portfolios have similar mean reversion strength. You can see from their mean reversion half-life. Both of them are will mean revert at around 18 days. However, for the dense portfolio, you will need to trade all 45 assets. And you can actually see from the range of the portfolio value, this portfolio actually have like low volatility. And since the portfolio has like low volatility, you might need to increase your leverage because you need to put a big position to extract enough profits for your trades, and you might need more time for your like the position maintenance. However, if we're trading a sparse portfolio, we can trade on similar mean reversion strength, but here the volatility is higher, and you can enjoy the benefits of like lower transaction costs and easier to interpret P&L. So the advantage of having a sparse portfolio is kind of obvious. So now we're trying to figure out how can we construct a sparse mean reversion portfolio from a large basket of assets. So one key factor here is we need to quantify how strong the mean reversion is. So here you can see three examples. The first portfolio is a weak mean reversion portfolio. You can see it will like take almost like more than 2 years, almost 3 years to mean revert. And the second example is a portfolio with medium mean reversion strength. It will like take half a month to mean revert. And the last portfolio is the strongest mean reverting one. It almost looks like noise. It will like take 2 days just to mean revert. So we need to have a quantity just to quantify the mean reversion strength. Half-life here is one of them, and we can relate the half-life to the Ornstein-Uhlenbeck model. So in Ornstein-Uhlenbeck model, we can have a direct representation of mean reversion strength. This is denoted by the lambda. So lambda is the mean reversion speed, and you can derive the mean reversion half-life by dividing the mean reversion speed by logarithm of 2. The advantage of using Ornstein-Uhlenbeck model is we can use the mean reversion speed as a standard to compare mean reversion series. However, for our mean-reverting portfolio selection problem, this is like an optimization problem. We really cannot relate or connect the mean-reversion speed to the portfolio weights, because the portfolio weights is the ultimate thing we care for, and it's very hard to optimize. So instead of like using the mean reversion speed in the Ornstein-Uhlenbeck model, we need to find some other proxies to quantify mean reversion strength. So one of the candidates is the predictability of the time series. And this is closely related to the Box-Tail canonical decomposition. So under the Box-Tail framework, they assume that the asset prices follows a vector autoregressive model of order 1. And today's portfolio value is a prediction built upon all past values of the process up to yesterday. So assuming here we're using daily data, you can use the previous time unit if you're using intraday data or like data with finer frequency. And the portfolio value also have a independent Gaussian noise added. So under this assumption, we can define predictability as a variance ratio. So it's basically the variance ratio of the predicted value and the real value of the portfolio. So when predictability is high, that means the variance of the prediction dominates the noise. So that means the process can be accurately predicted. And to use an example to showcase this, you can see on the right, the high predictability time series is very much looking like a momentum series. You can use a trend following trading strategy to trade this. However, if the predictability is low, that means the independent Gaussian noise is dominate the noise. So the process will look much more like the Gaussian noise. And this is what we want. If the time series looks very much like the Gaussian noise, that means it's like strongly mean reverting, and it's probably like stationary. So we can now summarize. We want to lower the predictability to achieve higher mean reversion strength. So the question now has become, how can we minimize this predictability under the constraint that we can only trade a few assets? So if we actually write out the vector autoregressive model, we can actually write this as the following equation. So and then we can use the portfolio weights to actually build the portfolio using the multivariate asset price process. So here we assume zero mean for each asset price, and then the predictability can be expressed as this formula. Zero mean is very easy to achieve. And actually in our implementation in the ArbitrageLab for the sparse mean reversion portfolio selection, we always demean the asset prices first. And in this formula, the gamma is the covariance matrix of the asset prices, and the covariance matrix is the key to solve the sparse mean reversion portfolio selection problem. And we can notice that right now, if we write the process, the portfolio process as a linear combination of the assets in the investing universe, we can actually connect the predictability to the portfolio weight vector. So now this is like a more well-formed optimization problem. So we can minimize this function based on all the info we have. The covariance matrix we can derive from the asset price data, and the VAR1 model coefficient matrix can be obtained by fitting a VAR1 model. And if we do not consider the constraint, then the Box-Tail canonical decomposition solve this problem. And this is actually a generalized eigenvalue problem. In order to obtain the solution to this minimization problem, we can actually solve the a generalized eigenvalue problem. And yes, so after you solve the generalized eigenvalue problem, you can choose the minimal eigenvalue and use the corresponding eigenvector to use as your vector weight. So apart from the predictability, there are two other proxies that are worth mentioning. So the first one is the portmanteau statistic. So this is a statistic that measures if a process is white noise. And there's like also the crossing statistic that measures the expected number of crosses around 0 per unit of time. In the later section, in the semi-definite, in the convex relaxation part, I will show you how to optimize these two statistics as well under the convex relaxation framework. So now we can jump to the main part of the problem. So how can we select a sparse mean reversion portfolio? So without the constraint of a sparse portfolio, the problem is actually easy to solve. You only need to solve the generalized eigenvalue problem, which can be solved in cubic time. However, once we add the sparse constraint, then this problem becomes a non-polynomial hard problem. Here the cartoon actually shows the another NP hard problem, which is the traveling salesman problem. As you can see, all of these problems can take either factorial time or like exponential time to run. So if we're using a brute force search, for example, if we're want to use the brute force search on our 45 assets, it will just take forever. You won't be able to get any results. So now we know that the sparse constraints actually make the problem hard. So instead of like getting the global optimal solution, we want to actually have a approximate suboptimal solution, because you don't really need like the strongest mean reversion portfolio. As you can already see, the strongest mean reversion portfolio actually look like noise. You want something that is like moderately or properly mean reverting, but like not taking too long to mean revert. So here we have like three approaches. The first one is to keep your asset universe small. So if we can find a way to narrow down our asset universe, so even like the brute force algorithm is manageable. So here we're talking about like probably less than 10 assets. And in order to achieve this, we want to exploit the conditional dependent structure of asset prices. And in order to do this, we will use the lasso models to discover small clusters within the assets. We're going to actually use a family of lasso models, including graphical lasso, the vanilla lasso you're most familiar with, which is the L1 norm regularization regression. And we will also introduce a multitask lasso that can suppress the entire column of like the matrix into zeros. Or we can use an greedy algorithm to directly construct a sparse solution from scratch. So this is like a fast heuristic that can more than half of the time yield an optimal solution. So between like the performance or the optimality and the running time trade-off, greedy algorithm is probably like the first choice if you want to build a sparse portfolio. And then we can go really fancy into the convex relaxation framework. So the cardinality constraint is a non-convex constraint. We can relax this cardinality constraint into a convex constraint, aka the L1 norm. So under this framework, you can actually have more flexible control on the portfolio properties. For example, now you can control portfolio volatility. And also, the convex relaxation framework is compatible with other mean reversion proxies I've introduced before. But for now, we're going to focus on minimizing the predictability. All right. So first, we're going to talk about how to use lasso to narrow down the investing universe. So here is a flowchart of how you can use lasso to find asset clusters. So basically, there are two angles or two lengths you can view the conditional dependence structure in the underlying assets. So the first one is the sample covariance estimate. So basically, you can analyze the covariance matrix to find the conditional dependence between the assets. And also, we can analyze the conditional dependence using the vector autoregressive model coefficient. So you can see three kind of like lasso models are used here for obtaining a sparse covariance estimate. We're going to use graphical lasso to suppress the edges and trying to get a sparse covariance estimate. Once we get this sparse covariance estimate, we can plot the graph of the inverse covariance estimate. Because under a Gaussian model assumption, a graphical model assumption, if there are no edges between two nodes in the graph representation, that means these two variables are conditionally independent, conditioned on the other variables. And for the VAR1 coefficient, we can use either column-wise lasso or the multitask lasso to get a sparse estimate. And after we get the sparse estimate, we're going to plot the graph of A transpose times A, because the VAR1 coefficient is not necessarily a symmetric. And in order to get a conditional dependence graph, we want a undirected graph, because the dependence between two variables doesn't really matter. I mean, the sequence doesn't really matter if we're just considering the conditional dependence between two variables. And we will calculate the intersect of these two graphs, and then we can get a really small asset class clusters that we can either apply a greedy algorithm or convex relaxation, or even a brute force search to get the best mean reversion portfolio. All right, so what is graphical lasso? So this is a model to obtain a one norm penalized maximum likelihood estimation of the inverse covariance matrix of the data. And the parameter we can tune here is alpha. So alpha is the regularization parameter. The larger the alpha we provide, the sparser the estimate of the inverse covariance matrix you will get. So that means most of the edges in the graph representation of the inverse covariance matrix will be suppressed. So here I have a animation to show you how the graph will change with respect to the value of alpha. I hope you can see the animation now. So you can see as the alpha increase, the edges in the graph are just disappearing. So you can always use ArbitrageLab to select the optimal alpha to achieve the sparsity you want. Okay. And here is the actual covariance matrix obtained from the graphical lasso model. As you can also see that with the increase of alpha, most of the elements in the covariance matrix has been suppressed to 0. So as always, this parameter tuning might take some time because you want to reach a balance between like a well-defined structure, but also not erasing too much structure of the matrix. Okay, so once we get the covariance matrix estimate, Now we will look for the structured VAR coefficient estimate. So here we actually have two options. So we can either use the vanilla lasso regression on the VAR1 model. So in order to do this, we're going to do this column by column, asset by asset. So we're using like the asset price matrix at the previous time point, and use that as the as one of the regressor, and we're going to do a univariate regression on this thing, and we perform this like asset by asset, and in the end we'll combine all the columns of this A together to get our sparse estimate. Or we can just suppress the entire columns to 0. Here you can see, although this is not exactly a L1 norm, but the exponent is the same. You have a square and you have the sum of square and you take the square root. So basically this is still a L1 norm equivalent. So I also have two animations to show you how exactly this will work for real data. So here is the column-wise lasso working on the VAR coefficient matrix sparse estimate. As you can see, when you increase the lambda, most of the elements will gradually turn into 0. However, the diagonal will still stick. So if you're doing like column-wise lasso, the diagonal will always stay there. But on the other hand, if we're using multitask lasso to obtain a VAR coefficient matrix, then you will see the entire column will be suppressed to 0. And as the lambda increase, the solution actually looks like it's losing like numerical stability. So same with the sparse estimates on the covariance, inverse covariance matrix. You want to strike a balance between enough sparsity but not too sparse, or too numerically unstable solutions. Okay, so once we get these two matrices, we can obtain the cluster by calculating the intersection of the graph of the inverse covariance matrix and the VAR coefficient matrix timed by its transpose. So how does this look like? You now can use the matrix to actually do a graph representation. And all you need to do is to calculate the common edge between these two graphs. And the edges that are remaining will connect the nodes or the assets, and the connected components of the intersection graph will be your clusters. As you can see, after the after the sparse estimate, after these all these steps, you will be able to get a very sparse and very small asset clusters where you can just perform a simple brute force search or a greedy algorithm to obtain the final mean reversion sparse portfolio. All right, so all of these looks like pretty much the pre-processing. We're not really doing much in finally determining the weight of the portfolio. We are just like trying to narrow down the investing universe. So in order to obtain the portfolio weights, we're going to rely on the greedy algorithm and the convex relaxation framework. So the greedy algorithm is rather straightforward. So we will iterate through all the assets, and we will select the block matrix that yield the least increase in the predictability. And we will repeat this until the cardinality constraint is satisfied. The reason why greedy algorithm is pretty fast is because we skipped many possible portfolios by building on the previous local optimal solution. And in the following study of the Dasperbaum paper, they reported that the brute force search was able to produce a stronger mean reversion portfolio than the greedy algorithm only 59.3% of the time. So you can see it's like more than half of the time you will get like a very optimal solution. So I think a greedy algorithm is like your go-to choice if you just want to explore the possible portfolios you can form out of a vast asset universe. And now I'm going to spend a little time introducing the convex relaxation framework. So recall that our optimization problem is to minimize the predictability under a sparsity or the cardinality constraint. So the cardinality constraint is a non-convex constraint, and we want to relax the non-convex constraint into a convex one. So what exactly does convex mean? So under the in terms of the convex optimization, the convex means when an optimal solution is found, it's guaranteed to be the best solution. So for non-convex optimization problem, there will be like many local optima or it's like saddle points where you cannot find a global optimal solution. There are already many tools to solve convex optimization problem. So if we can relax our non-convex cardinality constraint into a convex one, we can use these tools for solving the convex optimization problem, and this will like accelerate our process to find a sparse mean reversion portfolio. So the answer is actually very simple. In order to relax the cardinality constraint into the L1 into a convex constraint, we only need to change the L0 norm, which is the non-zero elements in the vector, to the L1 norm. And in order to transform the original problem into a better form convex optimization problem, or a semi-definite programming problem, we will work with the semi-definite matrix, which is the vector, the portfolio vector multiplied by its transpose. So now we can reform our optimization problem into the following optimization problem in the blue text box. So here we trying to minimize the predictability, which is written in the trace form under the L1 norm constraint. And we also added a unit norm constraint to improve the numerical stability of the solution. And the reason why this newly formed optimization problem is still not ideal is because there's like a quotient in the minimization objective function. And this is only quasi-convex. And in order to transform this into a convex problem, we will need to do some variable changes, which may cause some problem. So a better way to form reform this problem is to use the L1 norm as a regularizer. So instead of like using the L1 norm in the constraint, we will add a L1 norm to our objective function, and we will add a regularization coefficient to penalize the trace, that is the predictability. And under this framework, we can add more constraints. For example, if we want to have a portfolio with the volatility or variance no less than the sigma, which is like a predefined threshold, we can just add this volatility lower threshold into the constraint and still get a reasonable solution. And we can also use other mean reversion proxies to solve this problem. So here we can form the portfolio optimization problem into minimizing a portmanteau statistic with a volatility threshold. And with some changes, we can also minimize the crossing statistic with the volatility lower threshold. The only disadvantage for this formulation is now we need to tune the parameters, the regularization parameter, the rho, and also specifically in the crossing statistic optimization problem, we also need to tune the parameter mu in order to reach the desired cardinality. So now we have introduced all the concepts. I will show you how to perform the sparse mean reversion portfolio selection in ArbitrageLab. So ArbitrageLab provides the comprehensive solution on sparse mean reversion portfolio selection. In ArbitrageLab, you can do a Boxial canonical decomposition on the entire investing universe. You can tune and fit graphical lasso model for covariance selection. You can tune and fit column-wise lasso and multitask lasso for a sparse VAR1 model estimate. You can use greedy algorithm to construct a sparse portfolio. And you can also use the full convex relaxation suite. You can use semi-definite programming to optimize predictability, portmanteau statistic, and crossing statistic with volatility threshold. So in the following example, I'm going to construct a portfolio with 8 assets from the 45 international equity ETFs I've mentioned before. So first, let's show the greedy algorithm. So in order to get a sparse portfolio using the greedy algorithm, first you need to get a covariance estimate and the VAR1 coefficient estimate from your data. Here we didn't really apply the lasso optimization or the clustering for the asset universe. Instead, I will show you you can actually use this in the entire investing universe to obtain a sparse solution. So you can see the greedy algorithm chose the equity ETFs from the Egypt, Argentina, Brazil, Mexico, Colombia, Chile, South Korea, and Turkey. So most of these ETFs are from South America. And this might provide some interesting hints on the possible development in the market. For example, all of the South American countries are commodity exporters. So you might want to look at from this result, you can first construct a portfolio that you can trade with. And also it might tell you probably how the commodity complex is interacting with each other. And from here, we can see that the half-life of the mean reversion coefficient is about a month. So this is a reasonable mean reversion portfolio. And we only have 8 assets, which is pretty sparse. And here is the portfolio, how the portfolio value looks like. As you can see, this is pretty much very mean reverting around this mean, which is around 2. And it has sufficient volatility, so you don't need to put a very big position to profit from a small move from this portfolio value. And how about the convex relaxation with a variance threshold? So here we use the regularizer formulation of the convex relaxation optimization problem. And you can see that the algorithm still shows very similar portfolio of compared to the greedy algorithm. And the portfolio here is stronger mean reverting, as it will only take half a month to mean revert. And you can see, although the portfolio value looks a bit noisy, it still has sufficient variance that we can profit from. So these 2 examples have shown that our sparse mean reversion portfolio selection algorithm actually works. So what are some caveats when applying or implementing the sparse portfolio selection framework. So I have summarized some points that are worth discussing during my implementation of the entire module. So first thing, do we need to standardize the data or only demean the data? So do we only need to center the data, or do we need to also divide by the variance of each asset or the standard deviation? So for the lasso selection method, where you want to narrow down the investing universe into small clusters, because lasso methods are very sensitive to the scale of the data, I recommend you to standardize your data before fitting the lasso models. For example, I tried our model on the foreign exchange rate data, and the Indonesian currency against US dollars is trading around like 14,000. However, for Singaporean dollars against USD, it's only trading at around like 1.33. So the difference is at 4 orders of magnitude. And this high difference will distort the lasso results. So it's better for you. It's better just to standardize the data before applying any lasso methods. On the other hand, for box-tail decomposition, the results have shown that only center the data to 0 mean is the correct way to go. I tried to fit the box-tail decomposition model on the standardized data, and it doesn't really make any sense. And for convex relaxation framework, the results are pretty mixed. Sometimes it will work on the mean-only data, and sometimes it only will work on the standardized data. So in ArbitrageLab, I have given the users the options to either use the main data or standardized data to fit the model. It may sound a little bit like alchemy, but I think the best way for you is just to try it out and to see if the result actually makes sense. Actually, in the paper, there are another detail that is like often ignored. So after introducing the predictability in the remaining of the Daspermont paper, the author kept mentioning like maximizing the predictability, which is like contradictory. So after doing some literature research, I can be sure that you should be always minimize the predictability, because the lower the predictability is, the stronger the mean reversion is. And the same can be said for the Portmanteau statistics. And for crossing statistics, you want your time series to cross the mean as many times as possible. So a larger crossing statistics is better. However, if you're just trying to solving the minimization problem, you might encounter the numerical problems, because the eigenvalue can be very small. So if you want to have a more stable numerical solution, instead of like trying to minimize the predictability, you can try to maximize the reciprocal of the predictability. And this may help you to improve the numerical stability. And there's like one more thing, that's like the rank of the matrix X in the convex relaxation. Although in the formulation of the problem, we say that you can use the portfolio weight vector to construct this matrix. However, during the optimization process, you always initiate this matrix as a symmetric weight matrix, and then you use semi-definite programming to optimize this matrix. So this means the result you get from the semi-definite programming is probably not rank one. So you cannot decompose this matrix into a portfolio vector directly. And usually the matrix X is always full rank. So if you do a eigenvalue decomposition, you will get n eigenvalues depending on how large your investing universe is. So in order to recover the weight vector X, we follow the procedure in a following paper of the Das-Permon paper, and we will retrieve the leading sparse eigenvector of the weight matrix X using the truncated power method. This truncated power method is also implemented in the ArbitrageLab. So after each convex relaxation optimization, you should always run the truncated power method to deflate the eigenvector into the cardinality you want. All right, so I think that's all about sparse mean reversion portfolio selection. All the functionality in the ArbitrageLab is implemented, and I have left abundant options for users to play around and to see like if you can get an ideal sparse mean reversion portfolio. And here are the references, and all the papers can be downloaded from either archive or SSRN. Yep, and that's all I have for today. I'll be happy to take questions now. Yep.